Okay, let's go back to, sorry, not going back. This is a new problem here. Let's try to look at these bullet points and then journalize the transactions that relates to sales. Okay, so these 3 bullet points all relates to sales side of the transaction. You have the first one here. This company sells 2,500 books on account for $15 each. Okay, so each book, the retail price is $15, the problem tells you here. Second bullet point, it tells you that the customer returns 100 books to you and tells you the cost of the book. These 100 books were damaged, so but they returned to you, so meaning that in seller's viewpoint, you're actually collecting the inventory here, the second bullet point. Then the customer pays the balance overall later when it reaches October 22nd. There's credit term that you offered to this customer earlier, so you have to determine whether this transaction is within the discount period. Okay, so try to journalize this transaction on sales returns, and also finally the amount you're collecting your customer. There should be 5 entries here. First one relates to 2, second 2, third one 1. There's a 1 week practice questions that I forgot to give back to you last time, so I'm passing it around. Just pick yours. Okay. All right, let's take a look at the first bullet point here for sales transactions, and always any type of sales event, there's always two entries affected. You have one entry capturing sales revenue, the retail price that you're getting from customer. Another entry you'll be capturing the cost of the inventory. Okay, so here it tells you that we're selling the amount of the goods is 2,500 books, and it tells you for each and every book worth $15, the retail price that you're getting from customer. So for the total sales price, you'll just be using those two amounts and times those two together. That will be sales revenue. Okay, for the cost, it tells you directly, altogether the cost inventory amount is $22,500. Okay, so first entry will look like this. You have accounts receivable, $37,500, using 2,500 books times 15. And you have the inventory cost reduced, because again, you're now shipping out the goods to customer, you're reducing your inventory level, turn it into cost of goods sold expense. So whenever there's a sales transaction, inventory will be reduced and it turns into cost of goods sold expense. This account here is specifically there to capture inventory costs that you shipped out to the customer already. We call it cost of goods sold.
It seems like the cost for 2,500 books, 22,500. Why do they say that? Like, cost of these books?
Why?
Like, yeah. Is it the inventory?
It is the inventory cost. So which is why you see the dollar amount here.
And the first part you have to calculate.
First part is the price that's labeled on the book. So if you're the customer, you walk into the store, the price of each book is $15. And then you're now selling, if I'm the customer, I'm purchasing 2,500 books. Altogether, $37,500 would be the price I'm paying to the company, right? But the $22,500 was the original price that the company used to purchase from their supplier, the cost. Okay, so that's the purchase cycle. And now this is the sales cycle, the retail price that you're getting, okay?
Thank you.
And so most likely you will see a difference amount here because this is the whole point of a merchandiser's company. They're generating gross profit in between these $2 amounts. Okay, later on we'll talk about what the gross profit is. So basically it's the difference between retail price and cost. That's what they're gaining. Because this is the money that they spent earlier and this is the money that they're collecting from customer. Now the second two entries, the problem tells you that the customer returns a part of the goods and they actually ship back the goods back to the seller we're the seller, we're collecting the goods from them. So basically we'll be flipping these two entries. Specifically for sales revenue, we'll be capturing the dollar amount under sales returns and allowances. Okay, so again, as long as the problem tells you that the inventory is being shipped back to the seller, you would always have two entries for this. You definitely have one to capture also the inventory that's being collected back from customer. So the problem tells you that the cost of the good is $900, so you know this dollar amount already. You just directly use this $900 to increase inventory and reverse earlier's cost of goods sold expense. Okay, so inventory we increase here, cost of goods sold decrease because earlier we had a transaction on this. We're trying to reverse a part of this, $900. Now the $1,500 here comes from the retail price of each book is $15, and then you're getting $100, 100 books back from customer. So altogether, a customer later on will not be paying you this $1,500, which is why you're reducing the accounts receivable that you're getting from the customer. Okay, so sales returns and allowances, you'll see $1,500 here to reduce earlier the dollar amount that you captured in sales revenue accounts. It serves as a contra account, reduces sales revenue. At the same time, accounts receivable is being reduced because this is an allowance to customer. They will not be paying this damaged goods amount. Okay, so later on, the accounts receivable will be reduced from them. It will not be $37,500, but that amount minus $1,500.
Can you clarify the problem? So you're telling me that $900 worth of shipment is damaged?
$900, yes. The cost of the goods is $900. But the $1,500. No. We're now moving on to sales cycles, so it's no longer related to supplier.
Okay.
Supplier early on sold you the 2,500 books to you, and you're now reselling the 2,500 books to your customer. Okay, so if I own Barnes & Noble, I got the books for $900, and now earlier I got the books from $22,500. Now I'm reselling to my target customer, whoever that walks in. I'm selling them altogether this 2,500 books that worth, the retail price altogether is $37,500. I definitely need to mark up a price. After I get it from my supplier, I mark up a price that worth this, right? And now the 100 books that customer received, they're not satisfied with it. Either it's damaged or there's an error. They now ship it back to you. So if I'm Barnes & Noble, I got the books back. So they will not be paying this $1,500 anymore because this is not the product that they wanted. I'm giving them an allowance for $1,500. And that book, the cost that I got back, those books that now I regained into my warehouse now, altogether the original cost is $900. Not getting it. So there's two cycles here. We purchase inventory, then we sell it, right? So earlier when we purchased it, these 2,500 books, the purchase cost that I paid, Barnes & Noble paid to whoever their supplier is, they use up this money. This is the money that they use to get these books. Then they want to resell it to their customer. They supposedly should be getting this dollar amount from customer. Okay, but this is an on-account transaction, so the customer, Barnes & Noble, will be getting the money later on. Okay? Now, before they got the money, the customer inspected the goods. They realized 100 of them is damaged during the shipment. They don't want that anymore, so they return it back to Barnes & Noble, to your company. And this $1,500 is part of this $37,500. So you'll be reducing customer $1,500. Later on, they don't have to pay this amount in full because they ship back the goods to you. And the goods originally cost you $900 from here. Okay, so the $900 is for part of the cost that you purchased earlier. Earlier you thought this part of the goods shipped back. You don't have this inventory anymore, but now you got back $900 more because they shipped it back to you. Okay, so this is the original cost of each and every book that you used, the money you used to pay to your supplier. The $1,500 is the money that you're not getting from customers since they ship the goods back to you. Okay? So one is the retail price, one is the cost of the goods. Okay, so after these two entries, the last question would be, if the customer is now paying within the discount period, then what would be the dollar amount that they're actually paying to you if they get the discount? And so you have the sales returns amount $1,500 that you're not getting for sure. You know this for a fact because this is the goods that you collected back from customer. So the total amount that customer will be paying would be starting, the calculation would start from $37,500, the original amount, minus the returns, $36,000. Supposedly you should be getting this $36,000. After the discount period, you should be getting this. But since the customer is now paying within 15 days, you give them 2% off of this $36,000. Okay, so you see sales discounts here, 2%. The $720 you're also not getting from customer because they paid early. And so another case, the opposite case would be if they pay after 15 days, then it will just fully be $36,000, $36,000. Okay, but with the discount, you will have sales discount in the middle, capturing the amount of sales revenue that you're not getting. You have 720 here. So always when you calculate discount amount, don't forget to capture anything that's returned or any allowances that you grant to the customer. That has to be reduced first, because usually that happens within a week after customer receives the goods. In reality, that will be reduced before they even pay the dollar amount. Okay, so before applying the discounts, always subtract any returns and allowances first. Then you use whatever amount is after that, $36,000 that you got, then you apply the discounts. And so meaning that the total cash that company is actually receiving from this entire transaction, even though it started from $37,500, a part of that your customer returned to you, so you're not getting a part of that back. Also, a part of this $720 you offered a discount to them. So overall, the cash that you're really getting from this transaction is only $35,280. Any other questions before I move on? Okay, so just like purchase transactions, for sales we start from selling regular sales transactions with retail price, with cost affected. Then if there's returns allowances, and specifically if inventory is actually shipped back to the seller, then we flip a part of those two entries dollar amount. There's sales returns and allowances, and then you increase inventory again if the company receives inventory. If not, if this is a case without the seller actually collecting the goods, then you would not see this entry. You will only see the first one. Okay, so in the case that the goods are not actually shipped back to the seller asks the customer to just hold on to the damaged goods if they think that they can't really resell it to other customers. In this case, it will just grant them a reduced accounts receivable, and you won't see this journal entry. You will not have an increased inventory level. And so after returns and allowances, in case customers pay within discount period, just like how your company deals with vendors, if there's purchase discounts. For sales discounts that you gave to customer within the period of time, you also need to apply certain percentages here, meaning the cash that you're getting from sales from customer will be reduced. Okay, if not, if it's after the discount period, then it will be the full amount that you